My name's Tim Lawless. I'm the Head of Research with CoreLogic RP Data, and we're going through the January results for the CoreLogic RP Data Home Value Index. Well, the broad results across the combined capital cities was a 1.3% improvement or rise in capital city dwelling values. And when you start looking across the capital cities, we're still seeing Sydney and Melbourne being the primary drivers of the capital growth. So it is really a tale of two cities here. We're seeing Sydney and Melbourne driving a very high rate of capital gain, and most of the other capital cities recording relatively sustainable rates of growth. In fact, we're seeing Canberra values are now down over the past 12 months, and Perth and Darwin dwelling values have actually slowed substantially since they peaked back in 2013. Well, the initial results for January of 2015 were very strong, surprisingly strong in fact. We saw values rise by 1.3% across the capital city index, but the long-term trend is actually one of tapering, one of slowing. So we saw the marketplace peak back in April 2014 with values growing at about 11.5%, and we've seen that annual rate of growth drift down to 8% at the end of January. Our view on the rest of the year is we probably will continue to see that tapering in the rate of capital gain due to a whole bunch of things. Firstly, affordability constraints are becoming quite apparent in the marketplace, particularly in Sydney and Melbourne. We're also seeing rental yields being compressed due to the fact that rents aren't moving anywhere near the same sort of pace as values. And finally, we're looking at 2015 being a year of much tighter financial constraint, particularly for investors. At the end of 2014, we saw APRA warning lenders on high levels of investment lending, and we'd expect that will result in some more contained investment lending during 2015. Well, I think over the first half of the year, we will see interest rates coming down. In fact, over the full 2015 calendar year, my view is we'll probably see a 50 basis point cut to the cash rate. Currently, the Reserve Bank has a really tough time on their hands deliberating where interest rates are going. The last thing we want to do is add more fuel to the housing market rate of growth. But of course, they also want to stimulate economic growth, like to bring the Australian dollar down further. And the gap between bond yields and the cash rate is virtually nothing at the moment, which suggests that the financial policy or monetary policy is a little bit tight at the moment. So in a nutshell, interest rates are heading lower. It's just a matter of when. Well, I think 2015 in many ways will be tougher than 2014. 2014 we saw record numbers of dwelling approvals, record numbers of dwelling starts. We saw transaction numbers very high as well. And the indications are that we'll probably start to see transaction numbers starting to taper away, partly due to affordability, partly due to tougher lending requirements from Australia's banking sector. Now, as the marketplace does start to wind down from a capital growth perspective and a volumes perspective, for real estate agents it comes back to diversification. Looking at rental management, for example, I mean, we're at record numbers for investors at the moment, which means we're seeing a record number of new investment properties hit the marketplace. So those real estate agents that really want to diversify, they should be looking more at their rental books, making sure that they're getting the most out of the rental market at the moment, which based on rental rates is very soft. But the number of new investment properties coming online is quite substantial. Well, if I had $1 million, I probably would be looking outside of the Sydney and Melbourne market just because they have seen so much capital gain over the past 6 years, or at least since the beginning of 2009. We've seen Sydney values rise by 57% and Melbourne values up by 50%. I'd probably be targeting those cities which are quite early in the growth phase. I think Brisbane is showing probably the best fundamentals of any capital city at the moment, in the sense that we are seeing growth in the marketplace. Yields are still relatively healthy, much higher than what they are in Sydney and Melbourne, and the economy isn't overly soft. Sure, it's not as strong as Sydney's, but unemployment's come down and we're seeing jobs creation and we're seeing tourism coming back into the southeast of the corner of the state. So I think Brisbane would be my first pick, particularly detached housing in Brisbane. And as an outsider, I think Hobart as well. We're seeing Hobart has been one of the weakest markets around Australia of any of the capital cities. It's the most affordable, it's got the second highest yields of any capital city, just after Darwin. And even though the economy there is quite weak, it is improving. So we're seeing lower jobless numbers now. We're seeing a surge in developer confidence. It's about 10 years highs now for dwelling approvals. So I think Hobart is finally starting to emerge from a very soft conditions, and there's some bargains to be had in that market. So I suppose in summary, we are seeing very strong housing market conditions across Australia, mostly concentrated in Sydney and Melbourne. But importantly, we are seeing that rate of capital gain tapering now. Well, they have been, the rate of capital gains have been tapering since April of last year. So our view on 2015 is not quite as strong as 2014, particularly in Perth, Darwin and Canberra, where those markets are clearly in slowdown. But I think we're also seeing an ongoing tapering in Sydney and Melbourne also.